Chapter 13. Statement of Cash Flows. The cash flow statement focuses attention on a firm's ability to generate cash internally, its management of current assets and current liabilities, and the details of its investments and its external financing. Positive cash flows permit a company to take advantage of market opportunities, pay dividends to owners, expand its operations, and replace needed assets. Wall Street analysts consider cash flow an important indicator of a company's financial health. Cash equivalents are short-term, highly liquid investments that are both readily convertible to known amounts of cash and so near maturity that there is little risk of change in their values if interest rates change. Part 1. The statement of cash flows reports cash inflows and outflows in three broad categories: operating activities, investing activities, and financing activities. Part 2. The operating activities section reports the cash effects of the elements of net income. Part 3. The investing activities section reports the cash effects of the acquisition and disposition of assets other than inventory and cash equivalents. Part 4. The financing activities section reports the cash effects of the sale or repurchase of shares, the issuance or repayment of debt securities, and the payment of cash dividends. We will discuss each of these sections in more detail in the next few slides. Many decisions benefit from information about the company's underlying cash flow process. Cash continually flows into and out of an active business. This graphic illustrates several examples of cash inflows and outflows classified as operating, investing, and financing activities. Take a few minutes to review these examples before we take a closer look at each section. Cash flows from operating activities are cash inflows and outflows directly related to earnings from normal operations. Cash inflows include cash received from customers and dividends and interest on investments in other companies. Cash outflows include cash paid for purchases of goods for resale and services, salaries and wages, income taxes, and interest on liabilities. The cash flows in this section are illustrated in the examples in this slide. There are two acceptable formats for presenting the cash flows from operating activities. The direct method reports components of cash flows from operating activities as gross receipts and gross payments. The indirect method adjusts net income to compute cash flows from operating activities. Note that no matter which format is used, the same amount of net cash flows from operating activities is generated. Cash flows from investing activities are cash inflows and outflows related to the acquisition or sale of productive facilities and investments in the securities of other companies. Included in this classification are cash payments to acquire property, plant, and equipment, and investment in securities of other companies. When these assets are later sold, any cash receipts from their disposition are also classified as investing activities. The cash flows in this section are illustrated in the examples in this slide. Cash flows from financing activities are cash inflows and outflows related to external sources of financing, owners and creditors, for the enterprise. Included in this classification are cash inflows from borrowing on notes, mortgages, bonds, and other debts from creditors, and from proceeds from the issuance of stock. Subsequent transactions related to these financing transactions such as a buyback of stock, the repayment of debt, and the payment of cash dividends to shareholders, also are classified as financing activities. The cash flows in this section are illustrated in the examples in this slide. Here is the statement of cash flows for Boston Beer. As you can see, since the operating activities section starts with net income, Boston Beer uses the indirect method. The indirect method is used by 98.3% of companies. In addition to the three sections, operating, investing, and financing, there is also a cash reconciliation at the bottom of the statement. The ending cash balance on the statement of cash flows should agree with the cash balance on the balance sheet. Preparing and interpreting the cash flow statement requires an analysis of balance sheet and income statement accounts that relate to the three sections of the cash flow statement. Preparers must analyze the numbers recorded in the accounts under the accrual method and adjust them to a cash basis. To prepare a statement of cash flows, preparers need comparative balance sheets, a complete income statement, and additional details concerning selected accounts where the total change amount in an account balance during the year does not reveal the underlying nature of the cash flows. The change in cash equals the change in liabilities plus the change in stockholders' equity minus the change in non-cash assets. Thus, any transaction that changes cash must be accompanied by a change in liabilities, stockholders' equity, or non-cash assets. The next slide provides more detail on this concept. This exhibit illustrates the relationship for selected cash transactions and other accounts that are affected. For example, when a company collects cash on an accounts receivable, cash increases and the non-cash asset, accounts receivable, decreases. Take a minute and review the relationships highlighted on this slide. Remember that the indirect method starts with net income and converts it to cash flows from operating activities. This involves adjusting net income for the differences in the timing of accrual basis net income and cash flows, as shown by the items in the yellow boxes on this slide. Let's look more closely at the changes in current assets and current liabilities on the next slide. This table summarizes how to adjust net income for changes in current assets and current liabilities. If a current asset account has increased, the increase would be subtracted from accrual basis net income. Similarly, if a current asset account has decreased, the decrease would be added to accrual basis net income. For liabilities, increases are added to and decreases are subtracted from accrual basis net income. Transactions that cause gains and losses should be classified on the cash flow statement as operating, investing, or financing activities, depending on their dominant characteristics. For example, if the sale of equipment produced a gain, it would be classified as an investing activity. Gains must be subtracted from net income to avoid double counting the gain. Losses must be added to net income to avoid double counting the loss. We will use Boston Beer's financial statements on the following slides to help prepare the statement of cash flows for the quarter ended on March 31, 2007. Here is the comparative balance sheet for Boston Beer. The account changes have already been calculated in the last column for us. Here is the income statement for Boston Beer. We will use the indirect method so we will start our statement of cash flows with the net income reported on this income statement. Step 1 is to adjust net income for depreciation and amortization expense. We can find these amounts on the income statement. Step 2 is to adjust net income for changes in current assets and current liabilities. The changes in these accounts were calculated on the balance sheet a few slides earlier. We use this table to help remember whether to add or subtract the change in the current asset and current liability accounts. The operating activities section of the cash flow statement focuses attention on the firm's ability to generate cash internally through operations and its management of current assets and current liabilities. Most analysts believe that this is the most important section of the statement because, in the long run, operations are the only source of cash. That is, investors will not invest in a company, and creditors will not lend to a company if they do not believe that cash generated from operations will be available to pay dividends or repay the loan. As a result, cash flows in the operating section must be carefully analyzed. Let's take a closer look at the effects of changes in receivables and inventory. Managers sometimes attempt to boost declining sales by extending credit terms or by lowering credit standards. The resulting increase in accounts receivable can cause net income to outpace cash flows from operations. As a consequence, many analysts view this pattern as a warning sign. Inventory growth can be a sign that planned sales growth did not materialize. A decline in inventory can be a sign that the company is anticipating lower sales in the next quarter. The quality of income ratio is computed as cash flow from operating activities divided by net income. In general, this ratio measures the portion of income that was generated in cash. All other things equal, a higher quality of income ratio indicates greater ability to finance operating and other cash needs from operating cash inflows. Here is the balance sheet for Boston Beer that we looked at earlier. Let's focus on the investing accounts, which are short-term investments, and equipment. The balance sheet indicates that equipment increased by $8,000 during the quarter. However, if you had access to additional company information, you would discover that the company actually purchased $1,736,000 of new equipment and sold old equipment for its book value of $2,000. This is offset by $1,726,000 in depreciation expense, as noted in the operating activities section. In the investing section, we need to show the total amount spent on purchasing equipment. Short-term investments increased by $802,000 during the quarter. Although short-term investments is a current asset, it is reported in the investing section on the statement of cash flows. The capital acquisition ratio is computed as cash flow from operating activities divided by cash paid for property, plant, and equipment. In general, this ratio reflects the portion of purchases of property, plant, and equipment financed from operating activities. A high ratio indicates less need for outside financing for current and future expansions. Free cash flow is computed as cash flow from operating activities minus dividends minus capital expenditures. In general, this measures a firm's ability to pursue long-term investment opportunities. Here's the balance sheet for Boston Beer that we looked at earlier. Now, let's focus on the financing account Contributed capital. The net increase in contributed capital of $2,969,000 was caused by two transactions. First, Boston Beer repurchased $2,729,000 of outstanding stock, which is a cash outflow. Second, the company issued common stock to employees for $5,698,000, which is a cash inflow. The long-term growth of a company is normally financed from three sources: internally generated funds, the issuance of stock, and money borrowed on a long-term basis. The statement of cash flows shows how management has elected to fund its growth. This information is used by analysts who wish to evaluate the capital structure and growth potential of a business. If the company uses the direct method for computing cash flow from operations, it must present the reconciliation of net income to cash flow from operations. If a company uses the indirect method for computing cash flow from operations, it must disclose cash paid for income taxes and interest. These disclosures are normally listed at the bottom of the statement. Certain transactions are important investing and financing activities, but have no cash flow effect. These are called non-cash investing and financing activities, and supplemental disclosure of these transactions is required in either narrative or schedule format. An example of a significant non-cash investing and financing activity is the purchase of a building with a mortgage. Supplement A. Reporting cash flows from operating activities, direct method. The direct method presents a summary of all operating transactions that result in either a debit or a credit to cash. It is prepared by adjusting each item on the income statement from an accrual basis to a cash basis. This slide summarizes the way to adjust income statement items to a cash basis. For example, when sales are recorded, accounts receivable increases, and when cash is collected, accounts receivable decreases. Thus, to convert sales revenue from the accrual basis to the cash basis, we would add a decrease in accounts receivable or subtract an increase in accounts receivable. Take a minute and review the other computations on this slide. This is the operating activities section of the statement of cash flows prepared using the direct method. Notice that the net cash provided by operating activities of $2,131 is the same as that derived using the indirect method. Chapter Supplement B. Spreadsheet Approach. Statement of cash flows. Indirect method. The spreadsheet approach offers a systematic way to keep track of data. A spreadsheet is organized as follows. 1. 4 columns to record dollar amounts are established: beginning balance, debit changes, credit changes, and ending balance. 2. On the far left of the top half of the spreadsheet, each account name from the balance sheet is entered. 3. On the far left of the bottom half of the spreadsheet, the name of each item that will be reported on the statement of cash flows is entered. Let's look at a spreadsheet that helps with the preparation of the statement of cash flows for Boston Beer. After entering all the transactions, this is what the spreadsheet looks like. End of Chapter 13.